Well, 82, 83 points lower on the Nifty is what we have. Ajay Srivastava is with us, Chief Executive Officer at Dimensions Corporate Finance Services. Ajay, good to have you with us here. Thank you very much for your time. You know, we'll ask you about the airline business, and I think I have an inkling of your views on that. But your views on the market, have you been surprised with this move higher that we've had? Almost 4-5 weeks now, running into some resistance now. Your thoughts, Ajay?
No, I think first of all, I'm glad now that you can start predicting me. I think you are the best AI chat box out there, which is going to start predicting people with great stuff, man. You don't need people anymore. You got to compete on the other side. No, I think, if market, as we always said, that Indian market is less driven by fundamentals, more driven by flows. And we have seen the same thing happening. Once the selling of FI stopped, it was a natural course of the market to start edging up, and FIs have bought some stock in that. And therefore, the market has taken up a little bit of wings, so to say, to come back to where it was. But for investors, I think the dilemma again becomes same, that do you invest now or do you get out? And I think that's where the problem starts, that if you start investing again at 18,200 levels, what kind of returns you get? So more than the celebration of 18,200 for an average investor I'm meeting on the streets and the planes is more concentration on what do I do with it? When the market is down, they know what to do. But now they don't know what to do. So I guess, we're never happy.
Yeah, that's true. Since it's the big talking point, I'm going to ask you about it. The entire aviation space is booming, right? I mean, tickets are soaring, hotels are full, travel is back in a big way. And at such a time when Go First files for insolvency, Indigo has everything to gain. The stock is up 6.5% today, but for someone who's perhaps missed out on the rally, you think there's more to go?
Sonia, there's an old song called Fly, Robin, Fly. And this song so applies to industry. There is up to the sky. There is nothing else. And for Indigo, I own the shares for disclosure, so please don't take it as that. I still believe that if there is a competitor you want in the market, you want Tatas to be on the other side. That's the best competitor you want. You don't want Reliance on the other side. You want Tatas on the other side. So for Indigo, it is got an opportunity, and not that Tatas are going to make money. I spent some crazy amount of money on the flights, which is unbelievable last week. So I think sector has a very, you rightly said, a duopoly is now in the making. Not making, is already made. There's nothing much the government can do except put a lid on the prices, which I think is going to come very soon, in my view. So therefore, one would be wary of adding up more at this point of time and wait and see how the government reacts to what's happened on the pricing front. And, the pricing has gone crazy, absolutely bonkers. So while longer term, there is a clear story for both the players. One is listed, one is not listed, so you can't really participate in the other one. So therefore, as a sector, you can't get better than this because this is a clear monopoly. And as I said, you want Tatas to be a competitor. It's God sent for somebody like that. But it's unbelievable how Indigo has created this and what a niche they're in now. Unbelievable story. Story is still to happen. It's still just the beginning. I think the real one is going to happen in the next 2-3 years. As we saw what happened to the hotels. Same is going to happen here.
Hi, Jay. Good morning.
Good morning.
Put some cap on prices would be good, right? For us, not too good, I think, for the companies. But as you said, prices have gone through the roof. But Ajay, the consensus buy this year has been banks. But I think in the past, you have mentioned as well that you wouldn't be in that camp. You think there are better opportunities rather than banking names. What's your view on the banking stocks, the financial names from here on?
Still the same, Nigel. I still believe that as you're seeing unfolding, the luxury consumer discretion story has done a lot better. The metal story, banks, are an over-owned asset by the entire investor class. That's a problem with it. Stocks rise over time because they are under-owned and therefore new investors want to jump in. Everybody owns the bank. When the SIP goes in, they all buy the bank. And so the point remains that what's the trigger for the banking to give you superior than market return? That's what you're aiming for, right? You're not aiming for a banking sector to give you less than market or market. And that's where the trigger is not there because you don't have a monopoly kind of situation. You have a grandfather called RBI who ensures you get profits. And the fact remains that every time banks make money, it's at the cost of the rest of the economy because who's paid the interest? Is a common person has paid the interest, the corporates have paid the interest. So whenever banks do well, you will find that next 2 years, the economy lags. And when the economy lags, it's a cycle. The banks will start to have the problem, the loan. You already seen the first ECLS default has already happened. Go First, the first ECLS default. Many will follow in the path. The whole trajectory is personal finance. The whole trajectory of banking industry is personal finance. In an economy which is slowing down, unemployment is pretty well high at this point of time. Personal loans are perhaps the most riskiest loans. RBI has sounded a warning, but I'm not sure people are hearing it. But the fact is, the whole banking industry is today sitting on just the edifice of personal loan, unsecured loans. It can go on for some time. How long it can go on? So the composition of earning worries you about the bank's growth path. It's not the banks per se, but the composition of earning. And therefore, I still believe the Indian industrial economy, the high-end consumer spending sectors, some of the metal sectors will give you superior returns than the bank. You already own it in various forms and shapes. You can't not own it, but to over-own it perhaps is the problem.
You know, by the way, just have the NSE advance decline up. That's the advances have run away suddenly, and you'll be able to see it, I think. The gap is widened. It was almost 1:1, and now you've got almost 1,200 stocks higher and about just under 800 stocks which are lower. There you go. That's what I'm talking about. So the broader market is starting to run up once again, like what we've had over the last many sessions. Ajay, so actually two questions, but both are follow-ups. So what is your view? I mean, the first answer on markets, you said, well, people are not happy when the markets were down and they don't know what to do now. But what is your view? What to do now? And second, I think you threw in that line that maybe caps, FA caps are coming. You said you own Indigo. If that were to happen, I mean, you sell and run, or what do you do?
No, I think you just wait it out, because you've seen, different sectors, what government did. If you look at the steel, go back to look at the steel sector. That had a steep correction, it came back. So if you're a longer term, you will add on corrections. So if you see what happened to the sugar sector after the price control, and look just now the export ban, you've seen what's happened to the sugar stocks. So you've seen what happened to the oil stocks at the point in time. So government interventions obviously have a negative connotation to the stock, but that perhaps may be the time to get an opportunity to get into the stocks. And runaway situation like this, if you start to buy and make money, very difficult. Wait it out. Government action will come. It's election year. They cannot afford economy fares at 20,000 rupees, and people, the social media is a gosh, if you're all a part of it, I'm sure, is what's happening on the airfare. So I think it's coming. It will come. Whether it comes today, next week, what they do, I do not know, but I think it will come. That should be a right way to get into the market. Number two is, you said about the market. I still believe this is a good time to put some cash on in the books. Book your profits. If your chemical stocks have now recovered, I would say book your profit. If retail stocks have recovered, book your profit. If fashion apparel has recovered, book your profit. These sectors are going nowhere in this year. I can promise you this much. The market indications are that April has been very, very bad for the retail sector at this point of time. May is not looking, just started, so we don't know. But April has been pretty bad. So if you have got exposure to these sectors, this market gives you the best opportunity to sell. You love to sell when the market is green, because you can sell at a good price. You don't want to go to the market when it's 10% down. So I would say lots of sectors now have recovered, still overvalued. You may want to get out, book your profits if you have, and get out and put some cash. You will get chances to buy again. A lot of sectors are not going to perform in this year. Economies are 5 to 6, 7% at best, as RBI 6.5%. You'll get chances to buy. So don't worry about it. I would say book your profits in sectors which are weak, and certainly 5 or 6 sectors we can see are going to be very, very weak this year.
Okay, so you're saying that you're not buying anything now. You're still negative on equities. Since we last spoke, of course, you were talking about other asset classes as well. So this is not the time to be buying. This is still the time to be booking profits, right?
You can shoot me in the head to buy at 18,200 and make a return out of it. So just shoot me in the head. Might as well do that. Because, as I keep saying, that buying in euphoria gives you high.
I choose non-violence. This is for the benefit of our viewers.
Okay, you can substitute my chat box.
No, I'm asking because, a lot of the headwinds, so-called headwinds for this market are now, sort of easing, right? I mean, we were speaking to a global expert earlier who said now we're going to head into a cycle where there could be a rate cutting cycle from the US Fed. What happens then at the start of the new year?
See, rate cutting cycle is a precursor to the fact that the economy has to slow down for the rate cutting cycle to happen, which means the demand of goods and services have to drop, Sonia. That's the bottom line for a rate cutting cycle, which means that your demand for exports, demand of products has to go down in the market for for it to come into effect. And that also means in the first stage, that you are able to sell products and the growth of the companies will stall. Last year we had a good optical growth thanks to the high inflation. Now with inflation hopefully coming down, the optical element of growth will also start to disappear. And you've seen that already, that what's happening to the sales growth lines, what's happening to the net profit line, etc. So while interest cost will not go down eventually, the high interest costs are here to stay. But the demand of the product has to go down first before the interest rate cycle comes down. And when demand goes down, company performances should lag. And we're already seeing in the market that the portion of the money going to the bank, extra EMIs, is going away from some place. That's one. Number two is globally and in India, Sonia, most importantly, people are trading experiences for goods and services, not services, goods particularly. So you rather take an expensive holiday or expensive hotel, then go buy a new phone or buy a new watch or buy clothes. So, so we also as investors need to change our mindset to say, when people are demanding experiences versus goods, it's best to be invested in companies giving experiences and not goods. So yes, interest rate cycle should come down eventually and everything goes up, goes down. But the fact remains that the world economy is not going to grow into 4 or 5%. India is not going to grow at 10%. When India grows at 6%, there is only so much companies can grow. And that's a perspective you got to keep, to claim and use the market highs to your advantage.
All right. Thanks a lot, Ajay, for joining in.
Thank you very much.
Would love to chat some more, but we'll take this forward at another time. Thanks for being with us on CNBC TV 18.